Jai Jinendra, good evening, everyone. Hope you're all well, keeping safe, and enjoying the good weather we're having at the moment. Today's session, we're looking to provide information to our members in a way without knowledge. We assume that you have no knowledge of any of these things, and hopefully it helps those people who want to know and people who already know some information, so they may be able to get something out of this. We'd like to introduce my co-host with you today, who is Vinay Shah, and myself. We've been in financial advisors for over 25 years and have been advising clients, small individuals to SMEs, small, medium-sized enterprises. What we'd like to do is just share some of our knowledge and thoughts with you. Today's topic is going to be property and pensions. There are 8 sessions, which will be shown in a second or two, which we'll do more or less every fortnight, and hopefully we will get some value out of this. We're not going to be giving advice. We are designed to give you information, educate our members, and give you an overview of personal financial planning. For detailed information, we always suggest that you speak to a professional, whether it's an accountant, financial advisor, or a solicitor. We're not going to be giving advice. We will take questions at the end of the session, and there's probably not a lot we can cover within that time, but we'll try and cover as much as we can. So what we're going to do, move on to, is why we invest in properties. So, many people have invested properties, have gotten properties themselves, property they live in. In UK, it's probably one of the things that everybody wants to do is buy a property for themselves to live in or to invest in. So why do we do it? It's quite easy to know why. People can see it, can feel it, and it's there. It's not going to be lost here today, gone tomorrow. And it's easy to understand. People know it's a house, 2-bedroom. They understand. It's easy to understand, as opposed to some of the other financial investments. It's become popular of late because a nationwide survey of 2021, or February 21, showed that in years between 2011 to 21, there was a 50% increase in house prices. So that's from an average house price of 160 to 240,000 pounds. That's outstripping inflation. So what are the reasons for this increase in house prices? Incomes have been rising for some people. Interest rates have never been lower since 2008 financial crisis. Their interest rates have dropped to what it is now is 0.01%. 0.01%. So it's incredibly low interest rates. And people have invested in more than one property. People have got their house, they then buy an investment property, 1, 2, many more for some people. So that's led to an increase in demand for houses. And also there's shortage of housing in the market. So this shortage of houses, it creates more demand for rental properties. One of the other things that's happened is also you've got the lending has become much more flexible on buy-to-lets than it's ever been. In the past, you had to be looking at various sources of income. You needed to have a certain amount of income, but now it's much more flexible. There are more lenders on the market as well. So that's kind of fueled the demand for houses and the price increases, especially in London. Outside London, again, the prices have risen, but not as much as they are in London. So what does it do? It provides income for people investing in property, provides an income. And in looking at the yields, they've fallen in recent times, but overall, if you buy a property, you will get an income, a positive income. We've lost some of the tax benefits that you used to have, but that's not deterred people from buying properties. Stamp duty is increasing, 3% additional stamp duty for investment properties. But again, we're still seeing the demand for properties. People want to buy properties for their own self or for future investments. This is, as I said earlier, it's an asset that people understand. People understand property, they can see it, feel it, and that's why one reason why it's so popular. When you're investing in properties, it's not that you have to buy the property, invest 100% of your money. You can borrow up to 85% in some cases for buy-to-let investment. The 75% is the norm, but there are lenders that will give more, and that gives a good return on investment. So if you're putting down £25,000 on a £100,000 property and you're getting £600 to £800 a month income, that's good return in some cases, and always knowing that the property is going to be there. One of the other things that I was told by another financial advisor is that buy the biggest property you can for you to live in, because when you sell that property, there will be no tax on that property. The proceeds will be free of tax, and you can then use that for income in retirement. So overall, property is a good investment for a lot of people, and we're not saying which is right or wrong, but we're saying it's a good investment for a lot of people. It provides income, provides capital growth, and above all, it's something that people understand, and that's one of the reasons why property is quite popular. So I'm going to hand you over to Vinay now, who will go through some of the other factors that you need to consider when you're investing in property.
Thanks, Paresh. So as Paresh said, obviously property is a good investment and has been for many years for people who have invested in property. So what's happened recently is we just wanted to go through some of the disadvantages now of investing in property. Some of the biggest disadvantages that we've seen recently is due to government changes to have made investment in property and being a landlord more difficult. There ultimately isn't enough property in the UK to go around. And so the government is trying to discourage investments into properties. Sadly, there is not a lot you can do about this. One of the biggest disadvantages of property as an investment is capital gains tax. When you sell a property, you end up paying capital gains tax on the profit that you make. You do have a capital gains allowance. For 2021, it's £12,300. And thereafter, the money that the profits that you make are taxable at your highest rate of income. So for people who are basic rate taxpayers, you pay at 18%. If you're a high rate taxpayer, you pay at 28%. But on other investments, which are not property, the banding is 10% and 20%. So therefore, property has a disadvantage from a capital gains point of view. Cost of acquisition, stamp duty, legal costs, all of these things are things you have to face when you buy property when you buy property. Upfront legal costs, valuation fees, additional 3% stamp duty. You will need to provide various certificates for energy performance certificates, gas certificates, electrical safety certificates, which all cost money. You will not pay the extra 3% stamp duty if the property you're buying is replacing your main residence. It's only on additional properties you bought for investment. You can use the stamp duty calculator on the government website to work out how much the stamp duty will be before you purchase. So you've got a good idea of what sort of money you need to put aside for stamp duty. The other thing, the biggest other factor that has happened recently since April 2017 is that some of the allowances that you are able to offset against your profits have been restricted. So for example, mortgage interest relief now has been restricted. Landlords can no longer claim or deduct expenses for finance costs from their property income, such as mortgage interest, interest on loans to buy furnishings, fees incurred when taking out or repaying mortgages or loans. So no relief is available for capital repayments of mortgage as well. So it's only the interest element that you get some relief on. Whereas in the old days, you used to be able to offset the whole amount. Now the basic rate, the mortgage interest relief has been restricted to the basic rate for income tax liabilities. Ongoing costs, you will also need to factor in the cost of maintenance, repairs, estate agent fees, which will all eat away at your return ultimately. Rental voids, stress. Rental voids mean that if you have a mortgage, you'll be responsible to pay your mortgage on time, and long void periods and tenants not paying their rent on time can cause extra stress, especially in the current environment with people being uncertain about their jobs. Ultimately, your income from property will be hit. You will always get that annoying call from a tenant that the washing machine is not working, the boiler's packed up, and this could be at any time of the day, and it can be costly and it's a lot of hassle. If you're trying to manage property from a distance, that can also be challenging. So for example, if you own a property in Manchester, but you live in London, it means that you're totally reliant on agents or taking days out to go and sort problems out. This may not be the sort of hassle that you want. Not easy to sell or timing. Property can be difficult to sell. The market can change. It can take time to sell your property. It's not as liquid as most people think. It really depends on the market at the time. We've been fortunate in London and the surrounding areas, especially as demand seems to always be high in certain areas. And so we get this false sense that property will sell easily. In other areas of the country, it can be difficult to sell as demand is not as it is in London. You can't sell small chunks of property, obviously. As with other forms of investments, if you want to sell some of it, you don't have that choice. You have to either sell the whole property or nothing. Little regulation. Before I upset any of my estate agents and solicitor friends operating in this space, what I mean is there's little regulation to protect you as a landlord or investor in property. Estate agents and solicitors operate under huge amounts of regulation, as do all professional advisors. Property is obviously subject to inheritance tax on death, and it can be difficult when passing property down the generations. Many people have built up large property portfolios and made good returns on their investments over the last few decades. But it's not always easy to protect against inheritance tax, which ultimately is payable at 40% of the value on the balance of any of your property which is above your personal allowance, and some further exemptions which apply to your main residence under the main residential nil rate band. Lack of diversification is another problem. I'm sure it's the same for Paresh, but I've seen many clients who have property portfolios but little elsewhere. And this lack of diversification can be a problem when markets change. So I wanted to move on from some of the disadvantages on property to sort of look at some of the advantages on pensions as another method of investment. So a lot of people don't know, but you can actually start a pension from the age of 0. So most people are not aware of this, that you can invest in a pension for a child from the age of 0, as I said. which means that over the long run, it can grow to quite a substantial amount by the time your child reaches pension age. You can also benefit from tax relief. If you invest the maximum amount, which is £3,600 for a child, you'll get the benefit of tax relief, and you'll pay £2,880 on an annualized basis. So it can be a great way to invest for grandchildren and grandchildren. Growth is free of tax. As your pension benefits build up, the investments, as the pension builds up, your benefits from the tax, you benefit from the tax efficient growth that pensions can provide. And it can be tax efficient when you take money out of your pension. As I mentioned earlier, one of the biggest advantages of pensions is tax relief. So for example, if you're a basic rate taxpayer and you put £100 into your pension, then it actually costs you £80 because the government is giving you the £20 as tax relief. And if you're a high rate taxpayer, then that's 40%. So ultimately you pay £60 for every £100 that you invest, which I don't know any other investments that provide you that sort of uplift immediately. Most people these days are now enrolled into workplace pensions, where your employer makes a contribution of 5% of your salary and you pay 3% of your salary. The government will usually add money to your workplace pension in the form of tax relief when you pay into a pension or a workplace personal pension or a workplace pension. One of the other advantages of pensions is the wide choice of investments and diversification you get. With pension investments, you have the added advantage that the investments can be highly diversified, which is a good thing because it can mitigate risk and ultimately it protects your investments when markets fall. Most personal pensions have a limit of when you can start taking pension benefits from them, and this is usually set at 55. Although the state pension age has moved upwards in recent years from 65 to 67 to 67, and this will carry on increasing, you can still access your personal pension or your employer's pension before this age. Although the age of 55 that you can now take currently is also going to be moving upwards as well. So just something to be aware of. When it comes to taking money out of your pension, the biggest advantage that you have is that up to 25% of the money that you've built up in your pension as you can take as a tax-free lump sum. On the remaining 75%, you'll usually pay tax on it, but the amount of tax you pay depends on how you take your pension. So ultimately you have control over your income in retirement. So the options you have when you retire is that you can take the rest of your pension pot as a lump sum or as an income. And normally people take out an income which is known as an annuity, which guarantees an income for the rest of your life. So that's one way of taking your income. The other thing that has now happened more recently is that due to sort of something called pension freedoms, you don't have to now buy an annuity when you retire. You can carry on investing into your pension and take an adjustable income, which is known as flexi access drawdown, which means that you can be flexible as your needs for income increase or decrease as time goes on. And ultimately that dictates how much tax you pay. So that's a really good advantage. The biggest advantage of pensions, I would say, is the fact that it is free of inheritance tax. Any money that you invest in a pension sits outside your estate for inheritance tax purposes. So when you pass away, it can be a very, very good way of passing down money to the next generation. If you die before the age of 75, whoever inherits your pension from you can take the whole pot as they want without any payment of income tax. However, if you die after the age of 75, or when you die, the beneficiary of your pension pot will have to pay income tax on the money they take out, but it's at their highest rate of income tax then personally, so whether it be basic rate or higher rate. So it's still not as bad, potentially, as paying inheritance tax. So it can be a good way to invest and pass money on to the next generation, as well as securing an income for your retirement. Stock market tends to outperform most investments over the long term, we always say to anyone who invests in investments which are stock market based, invest for the long term. We'll talk about this a little bit more later on, where we'll show you some slides as to how investments have performed against property. One of the other advantages of pensions is that you can put commercial property into pensions, which can be a good way also to invest in property. The final advantage that I want to speak about is the fact that pensions are very heavily regulated. Pensions have had bad press in the past, with many scandals that have happened in the past, but now it's become a very highly regulated product, and it can offer you a lot of flexibility, which they didn't in the past. So I just wanted to hand back to Paresh to go through some of the disadvantages of pensions. Thank you.
Thanks, Vinay. The pensions, obviously, a good investment, but so many people are reluctant to invest in pensions. And there, I'll share with you some of the reasons why. Vinay mentioned that you can start your pension from birth. However, once the money's in the pension, it cannot be accessed until age 55, and from 2028, the age goes up to 57. So if people need money in an emergency, they can't access that money. And this is where some of the scams that come into play, which Vinay just mentioned, is there are various people who are desperate to get money out, will try anything, and they get unfortunately involved in some scams and lose considerable amount of money. You've probably read the press and seen what's happening out there. And that's another reason why the public don't like or trust pensions. And coming on to my second point is, people don't trust the advice they're getting. Why that is because of the past history. The regulations is much more tighter now than it's ever been before. The amount of work we have to do when we do advise clients is incredible. And so I think public members need to be aware of what's out there, talk to an expert, talk to somebody that you know or friends know, and always be wary. If it's too good to be true, generally is. Cost of running a pension is another concern for a lot of people. People complain about charges on their pot of money. And yes, there are charges involved in running a pension, as there are in anything that you do. If you buy a property, you've got to pay state agency fees, you've got to pay maintenance fees, and so forth. So pension is just like any other investment. You have to pay a charge. When you are drawing the money, okay, you get the tax relief at the outset, 20 or 40%, but there's tax to pay when you withdraw the money. So you could be paying between 20% upwards to your highest rate of tax, 40, 45%. Could you just next slide, please? Above, sorry. So, and I think also it's a complex subject to understand for a lot of people. A lot of people have got pensions from various companies they've worked for, various providers that they've worked for in the past, but they've left it. And I'll give you an example of a client I dealt with recently who had a pension that she had forgotten about. And when we made inquiries, we found that it was £86,000. When you think about the average pension pot in the UK is just under £62,000. So that's that's quite a significant sum of money that people have forgotten about. And the Association of British Insurers have looked at the figures, and at the moment, around 19 billion pounds of money remains unclaimed. And that's roughly 1.6 million pension plans people have not claimed. So that's an average of £13,600 on pensions that's not claimed. So we're going to share some links with you a little bit later, and we put them on the YouTube as well. So you can see where you can, if you've not got to your pension, you think you've got a pension somewhere, you'll track it down. The government website, very useful site. You can go there and hopefully track your pensions down. And if you find some money, please send me some as well. But seriously, I think it's worth checking your pension. And it is a complex subject for a lot of people. So again, this is why we say always seek advice and try and sit down and look at your pension. Like with anything else, it's like a plant. You've got to plant the seed, water it, look after it for it to grow. If you leave it, it may grow, but it could just die. So I think it's always important that we as investors look after that, just like you would look after your property, make sure it's maintained, otherwise it's not going to be rented. You're not going to get the income you need from there. So I think it's worth looking at, making sure that you do review your plans that you've got. Now, obviously the maximum that you can have in a pension at the moment is £1,073,000. Any excess above this on the current rules is liable to a tax charge of 55%. Now, knowing that most people have an average of £61,000, it may affect a few people, but generally most people are under those limits. So maximum is 1,073,000. One of the other things which we suggest you do is get a state pension forecast. Again, we'll share a link with you on YouTube and on the next page as well when we get there. So do look out for them. These are kind of useful tools to have. Trace your pensions, state pension forecast. Always get it, because you'll then know what you're going to get at your retirement age. For most of it, it's 67. So you will be able to get. You need generally 35 years of national insurance history to be able to get full pension. There are some exceptions, but that's the general rule. And if you paid in, fine. If you haven't, if you've got gaps, you can make up those gaps by making voluntary national insurance contributions to get the full pension. So I think that sort of brings us to the end of the program, not the program, but our kind of conversation. Now, the next slide, really, if you could bring Vinay back in. Looking at the performance of house prices over the stock market performance, equity-based investment.
Thanks, Paresh. So yeah, as you can see, if we look at house prices index since 1975, and we look at the MSCI, which is the World Index for Investments, although house prices have done very, very well, have given a substantial amount of return, and have been quite a steady sort of return. As you can see, when you invest in investments, the market is more volatile, but overall the returns have been substantially better. So it's always worth bearing in mind that we always feel that property has done well for us, and it has, there's no doubt about it. But you should also look at diversifying possibly in other areas. And this clearly shows that you should have eggs in all baskets, not just in one. Next slide, please. So this one shows a very similar pattern, but from a shorter period of time. It's basically showing house prices against the FTSE 100. most people understand what the FTSE 100 is the biggest 100 PLCs in the UK and their value. And as you can see, there has been times when the markets have come down in equities where pension property has done very well. And there are other times when the markets in equities has just gone up dramatically. And you can see obviously the last year, what the pandemic did to the stock market as well, but property prices have generally carried on in a consistent basis. So both are equally as good. They just have different perspectives of how you can get returns. I think that's the last slide for today. I think I'll hand back to Paresh and he can wrap up and summarize what we've been talking about today. So thank you.
Thanks, Nikuj. Just come to the last page. So here are some of the links, and I think one of the things that you should look at is diversification, as Vinay mentioned. Yes, have property, but I think also a mix of other assets. Not to put all your eggs in one basket. Sorry to all the chains here. It's just a phrase. So diversification into other assets. Review your investments, whatever they are, wherever they are. Talk to your advisor. Take advice. I think they've worked hard, whether it's an accountant, solicitor, or a financial advisor. They've worked hard to get the qualification, understanding of the rules and regulations. They do understand it well. Take advice from them. Now we've got 3 links here, which is tracing lost pensions, which we'll put on to the YouTube link at the bottom in a minute. If you want to get some free advice, go to Money Advice Service, which is a government-sponsored initiative to help people make some decisions, and also to get state pension forecast. It's very important because state pension is worth about £9,000 at the moment, so it's an incredibly good benefit. Daily Telegraph recently did a survey where they said that an average person would need £17,000 to live comfortably, and that's if they obviously their firm got a mortgage in retirement. So I think we'll kind of try and take some questions and bring Vinay back. Hi Vinay. So I'm not sure whether we've got any questions. Yeah, there's some questions from Lady Dina Shah. Is there an age limit of when I can take my 25% tax-free pension fund?
Yes, so as I mentioned, it's 55. So it depends on whether you're in a personal pension or a company scheme, but normally it's age 55 is when you can take your tax-free cash. But just remember, the earlier you take it, you haven't given your pension possibly time to grow, and so therefore the fund value could be less than what it could be if you left it a few more years.
So this is a good question here from Nix. Should someone in their 20s invest into SIPs or ISAs? SIP, for those that may not be aware, is a self-invested personal pension. So it's a pension where you can invest in your choice of investments. And that could, as Vinay mentioned, could contain commercial property as well. So the answer to this is yes to both, really. Would you say, Vinay?
Yeah, I think it depends on what you're looking. Yeah, definitely yes, but I think it depends on what you're looking for out of it. Remember, by investing in a pension, as I mentioned earlier, if you're in your 20s, then you've got to wait until at least 55, 57 to draw any money out of it. Whereas with an ISA, it's a lot more flexible. You can take your money out more or less when you want to. The only disadvantage being depending on market conditions as to what you might get back. So I would say it's a combination of both, but it depends on what it is you're looking to achieve. Is it a retirement? Is it saving for the long term? It could be either.
I think it also, what I would say is that we will be covering ISAs in another session soon, but ISAs are an incredible way of putting your money away where there's no tax relief for putting money in when you where it is with the pensions, but when you take the money out, it's free of all taxes, and it never needs to be declared on any tax returns once you've invested into an ISA. So it's a really good way of investing. And what I would suggest is people look at both options, don't rule out any one of them, because long-term retirement, short-term, or this is 10, 15 years, maybe you look at ISAs as a way of investing.
And just as a follow-on to that, obviously a lot of people can use ISAs to build up deposits for property. So it's a really good way to invest for the longer term, which will then ultimately provide you with a lump sum which you could use to buy your first home, possibly, or as an investment, or do something else with it.
Okay. So the question here, pension pot maximum of 1.73 million. Once the 25% allowance drawdown has been done, are the further investments in the pension pot allowed? And if so, what would be the max? If so, what would be the maximum? Still be 1.73 million.
So if you've started taking, if you've already taken your tax-free cash out, then basically new investments into the pension are restricted to £4,000 per annum. So what we're trying to say is that once you've taken the tax-free cash out, then you can still carry on investing in pensions, but you don't have the same level of potential growth that you may have seen previous to that.
And a question from Deepak Shah, should one put a property in a company?
Do you want to take that one, Paresh?
Yeah, I think that's quite topical at the moment because of the tax incentives have been removed for owning a buy-to-let in personal names. So a lot of people are investing in a property via a limited company. So it's there are pros and cons for either one. A limited company, you will pay a higher rate of interest if you're borrowing money. In a personal name, you've got CGT exemptions, which you could potentially use of 12,300 and per person, whereas in a company, you've got no CGT exemption. So it's something that you need to take professional advice. Only an accountant with your personal tax circumstances would know and could advise you appropriately. And there are, lots of pros and cons to either side. So it's a personal decision. Maybe for long term, it may be a good idea. But again, I would say seek advice from an accountant who knows your circumstances and can advise you, because it can be individually tailored. The other question is, how far back can you search out old pension with a previous employer?
Paresh, as far as I'm aware, and correct me if I'm wrong, there isn't a limit. Basically, there is a register, which obviously, if you log into the link that Paresh was telling you about earlier, it asks you certain questions, and by plugging those questions in from your national insurance record, I think it is, they pick up all the pensions you may have been part of in the previous past. So I don't think there is any restriction, but I could be wrong. I'm not 100% sure on that, so I apologize.
Yeah, I think answer to Mita is I think there isn't as Vinay said, there isn't if you have a pension, it's yours. So you can, you're entitled to that. As long as you've been a member of the scheme. There have been people who've been members of schemes for, less than 2 years in the past. If you were a member of a scheme and you left within 2 years, they usually returned the funds you've invested. So that no longer applies. So you can go back as far as you have, and use the link that we've sent on YouTube to look at the potential of going back. And also on the money advice service, there are plenty of other links on tracing pension funds, because some companies have been taken over and changed names. So you kind of forget where those companies are, who they were, and what their current name is. So if you go on the Association of British Insurers or Money Advice Service, you will find the links there and do a search. I think these are the safe links to go through. If you Google, you may go into some links which are probably not the most healthiest for you. So I think go into Google, Money Advice Service or the .government website. They've got an unclaimed register there that you can tap into. So I think that's kind of the question we've got at the moment. Nikunj, is there any other questions? I can't see.
Paresh, we have one more from Nidhi Shah. How do you see the business environment changing in the future and its impact on the property market?
So, so basically the investment, sorry, could you repeat the question again?
Sure. Nidhi Shah asks, how do you see the business environment changing in the future and its impact on the property market?
Right. Yeah. So obviously we're going through uncertain times at the moment. With all the will in the world, I think things will return back to normal at some point. We just don't know when. So the environment for investment and what that will do to the property prices and property market is still a bit uncertain. But as we say, always take a long-term view on both and choose the product, but maybe choose to not put everything into one place, diversify, and in the long run, that should give you a reasonable return over the long term.
Yeah, I think, Vinay, I agree with that totally, because if you take a short-term view, then we don't know what's going to happen. But over a period of time, whichever market you look at, whether it's property or the equity-based investments, you will see positive returns. And we advocate minimum 5-year view on everything, ideally a 10-year view, but 5-year view, 5 onwards is a good view to look at. If you trace back any indexes on house prices or stock market and a 10-year view, you will always come out on a positive outcome. And we've seen the property market outstrip inflation. Last year, in the time of pandemic, according nationwide, house prices grew by 7%. So there is demand for properties. Mitten is asking, can you give more information on annual pension allowance?
Yeah. Do you want me to take that?
Yeah.
So basically, if it's a personal pension, you have to, the things you can take account of are your net relevant earnings when it comes to the amount of money you can invest in a pension. So it depends on the amount of income you have. You can invest up to £40,000 per annum, but you have to have income that would substantiate that level of pension contribution. So for example, if your net relevant earnings were 20,000, then you can't put 40, the maximum you can put is 20. But if your net relevant earnings were 60,000, then obviously you can put the full 40,000 in any 1 year. And there's also another factor to bear in mind. If you haven't contributed possibly for a couple of years or 3 years previous, there is potential to carry forward some of the unused allowances that you have. But it's a calculation that, again, if you seek advice, someone can work out that calculation for you, where you can then take advantage of the times you may not have invested the money into a pension in the past.
Yeah. Thanks, Vinay. I think that's an important point, is carry forward of your unused allowances. So potential is for this financial year, only a couple of days away from it, but you could use this current year's unused allowances to the maximum 40,000 and then go back 3 years. So if you've not used any of the allowances, potentially 160, would that be correct?
Yeah.
Yeah. So £160,000 you could put in.
And one other point to make is, if you're looking to carry forward, you need to have been part of a pension scheme at some time in the past. If you're not part of a pension scheme, doesn't matter whether it's for a day or a pound, basically you can't carry forward if you haven't had a pension sometime in the past. And the other factor to remember is that if you are an owner of a company, a limited company, for example, then basically single contributions from your company can be a lot more tax efficient than doing contributions from your income, potentially. So again, there's a conversation that's worth having on that. But we've seen both sides of it. And if I were to choose, if I was a limited company owner, and I was in that position, then I would always say put the contributions to your company because it reduces your profits and ultimately your corporation tax. Whereas if you put money into a pension from your net relevant earnings, the income you've already paid tax on, you already paid the tax, national insurance, and everything else. And therefore, if you're getting tax relief back, the calculation sort of negates one negates the other, really.
I think
if you're employed, unfortunately, you don't have that choice.
I think that's again, Vinay, it's an important point because you could, it's a good way of extracting profits from a company,
yeah,
and going into a tax-free status, inheritance-free status. So it's a good way of extracting money from a company.
And one other point to just make, that could be something that might be worth thinking about. We had this conversation. We had this question earlier about whether to buy property in a limited company or whether to buy it in personal names. Remember, if you buy your property in a limited company, you're making profits in that company from the rental income. Nothing's stopping you using that money to put money into a pension, for example. So one could contribute towards the other as well. That's a possibility.
So leading on from there, Vinay, question is, can the limited company contribute to directors' pension even if they are not on a remuneration? Is there a limit?
There is an earned revenue rule on that. The terminology, forgive me, I've forgotten right now, but it's got to be
wholly exclusively.
Wholly and exclusive. That's it. Thank you, Paresh. I knew it was good to work with someone else on this. So yeah, if it's on wholly and exclusively rule. So basically, you can invest up to £40,000 through a limited company, regardless of the income that you have, as long as you can justify that it's wholly and exclusively for that purpose. So there are certain guidelines that we have to be mindful of when we look at that. But yes, it can be done.
So I think it's a question that probably needs to speak to the accountant and the advisor together. Your financial advisor and accountant need to sort of, or three-way conversation, client, advisor, and the accountant have to have a conversation there. Is there a this is from Jigisha Shah, is there a benefit in consolidating pension pots you hold separately?
Yeah, so it comes back to what we were saying, and I've done this exercise. I'm sure Paresh has done the same exercise for clients as well. Remember the situation, if you work for different companies over time, all the pension pots can, you can lose track of them one side, but more importantly, the investment that they're in can be different to what you want to be in at the moment, for example. So what I'm saying is that funds can fall out of favor, funds can do very well, but you don't have as much control possibly. And by consolidating pensions into one place, if it's the right thing to do, and again, advice is really required for this particular area, depending on the type of pension that you have, but it can make a lot of sense because, say, for example, I've done a similar exercise for a client who had 8 different pension pots, for example, from different various times she's moved up in her career and left a pension pot, gone to a new employer, started a new pension. And by consolidating, it's made her life a lot easier in terms of understanding that everything's in one place, one person's looking after it, one investment philosophy, one investment track to run on. It can just make things much easier. And when you come to obviously then take your pension benefits, you're looking at just one area or one pot rather than loads of different areas. So it can, but again, a very regulated area. So something that you would need to seek advice on for that reason.
I think, Vinay, it's an important point because one of the things that we've found, and again, I'm sure Vinay's done this as well, is that a lot of the companies that people have had pensions with are no longer advising. They don't have advisors. They don't are effectively closed to new business. So it's existing business only. And because of that, if you wanted advice, if you wanted any kind of information, I'm not kidding, but it's like pulling teeth. Because we've been there, we try and get information for clients, and it's not easy to get. So when when you consolidate, and I'm not saying that you just do this without sort of a good advice. It's do it if it's appropriate for you. There may be reasons why not, because there are some pensions which had guaranteed annuity rates. If you've got those kind of pensions, then it's probably not even worth thinking about doing those, where they're guaranteeing, I think, 11% annuity rates. So there are circumstances where you shouldn't do this, but an advisor will be able to give you that guidance when you've done this. But I think worth consolidating, because everything under one roof, you've got choice of investments, you've got advice and ongoing advice as well. So I think I would definitely look at that. So Nikunj, anything more at all?
No, there was just one earlier one. I think Rob Shah wanted to clarify the pension being 5%, 3% and not 5%. I think this was earlier on in the talk.
The contribution from the employer?
Employer, yes.
I believe it was 3%, but over time it has increased to 5%. I need to check that up, but as far as I'm aware, it's 5%. But I have read that it's 3%, so there is I think there could be a minimum for 3%. So it's a good point you make, and something we need to check up.
Okay, so
thank you, Paresh. Thank you, Vinay.
Thanks, Nikunj. I think that sort of brings us to an end. I think we have no more questions, but if people do have questions, please do drop us a line at oshwalweb@oshwal.org, and we'll happily respond to your emails. Our next seminar is on the 15th of April, which is about financial education awareness for the younger generation. As I said at the beginning, we're not going to answer every point that you have or people have questions, but it's generally increasing the awareness. Things that people know, or things that they know. Things that they think they know, but they don't really know. And it's really useful for people to ask those questions. We're happy to answer them and hopefully provide some guidance and steer towards a sort of better financial planning. Any final thoughts, Vinay?
No, I think it comes back to what we were saying earlier. Whether you go pension, whether you go in property, it's a personal choice, but a choice that should be made by seeking advice wherever possible, be it from an accountant, financial advisor, or a solicitor, or whoever it is that you take advice from. Both have advantages, both have disadvantages, and I would say the biggest thing is not to keep all your eggs in one basket, as we've said over and over again. That's probably the biggest thing I would say.
Thank you, everyone, for listening. We'll be back on 15th of April, and if you have any questions, do drop us an email, and we will try attempt to answer them. I think there is a question mark about the employer workplace pension. We may have got those figures slightly incorrect, but yeah. So it's the other way around. I think the employee is 5%, 3% for the employer. So apologies for that, and we'll correct that. But thank you all for joining, and have a good evening.
Thank you.
Bye-bye.